Volatility Risk Premium, better known in the industry as VRP, is one of the topics at this year's Cboe Risk Management Conference. Joining us now is Jack Hansen. He's the Chief Investment Officer of Parametric, here to give us a bit of a 101 on VRP. Thanks so much for being here.
Thank you, Angie, for having me.
So what do you think is the biggest takeaway from your panel? Because you're really looking at VRP and how people use it to enhance returns.
Mm-hmm. I think the key takeaway is that investors, smart investors in my opinion, are always seeking to have greater diversification as long as it can be accessed in a manner that's relatively low cost, both in terms of trading costs and also management fees. And one of the true diversifiers that I think has been and continues to be underrepresented in institutional and individual portfolios is something that we call the insurance risk premium, also known as the volatility risk premium, which is the use of options to create a return stream that can enhance a diversified portfolio's return.
Exactly. For a first-timer listening to this, just break it down.
So the volatility risk premium is really, in our world, thinking about it in terms of insurance. Most of the people that will be listening to this are quite familiar with insurance, hopefully generally happy, although once a year maybe be unhappy when they write their premium check or whenever that cycle may occur. But they have a positive utility from buying insurance on their car or their home. But the underwriters of that insurance earn an economic profit because they're providing that insurance to the marketplace. The same thing is true, analogous in the financial markets. There's a very, very active insurance market in S&P options and other index options, along with individual equity options that represent insurance contracts that have a premium that's paid by the buyer, earned by the seller, received by the seller, has a deductible, has a term, very much like insurance. And so what the VRP, the insurance risk premium, brings to a portfolio is the underwriting profit and return patterns associated with becoming effectively the deliverer of that insurance to the marketplace in a diversified portfolio.
What's happening with investors? Are they starting to rethink positions using VRP and some of the strategies?
I think that's been an ongoing effort in the institutional marketplace and for individuals for decades. It continues to be a search to find, again, legitimate diversifiers within portfolios. The hedge fund industry has grown up in the last 2 decades to be very sizable. One of the reasons that's occurred is people are seeking diversification. Now we know there are some problems with hedge funds that have been well publicized. Sometimes it's performance, oftentimes related to the high fees. Parties in the institutional marketplace and individuals are looking for, again, diversifiers that provide that legitimate diversification but don't have the costs and some of the other negatives associated with some of the other choices in the marketplace.
Where do you think VRP fits in?
VRP fits in as another allocation within a well-diversified portfolio. The concept is that most investors have a long or longer-term horizon and therefore can accept shorter-term volatility in exchange for the potential performance enhancement benefits of selling, in essence, financial insurance. So it fits in most portfolios in some measure, not a huge allocation, but not a small allocation, an impactful allocation that complements some of the other assets that they hold in the portfolio.
Well, nice to have you back at RMC.
I'm glad to be here. Thanks for having me.
Thank you.